Identifying Accounting Red Flags. Lecture 10. Lecture Outline. Hello, welcome to Lecture 10 of Equity Master Secrets. This lecture is about identifying accounting red flags. So the first thing we'll do is we'll talk about what is an accounting red flag, and we'll introduce the topic. And next we'll talk about why do companies distort financials. So when we think about accounting red flags, what we mean is that something in the accounts that seems a little bit wrong, or something that needs further investigation. And potentially this could be a result of companies distorting their financial statements. And to do this, we'll look at a few different types of accounting manipulation that takes place. So we'll look at dubious related party transactions, and the example will be the Satyam scam. We'll look at distortive depreciation practices, with Jet Airways as an example. We'll look at misrepresentation of revenues and costs, and specifically looking at the engineering, realty, and infrastructure sector. Then we'll look at Spurth in debtors and receivables. We'll look at Reebok India. And finally, we'll talk about contingent liabilities, and the example we'll look at is Sri Ganesh Jewelry House Limited. And one of the points we're going to focus on afterwards is the importance of cash and the importance of concentrating on cash, because cash is typically more difficult to manipulate as compared with earnings. And after that we'll conclude. Alright, let's get started. Accounting red flags. Introduction. So the first thing we're going to do is talk about what are accounting red flags, and we'll introduce the topic, and this will allow us to move on to the examples later on. So let's think about first what are financial statements. So financial statements are a snapshot of the complex web of financial activities of a business. And what makes financial statements sometimes quite tricky is that companies do a large number of transactions. Typically, a large corporate will have a huge number of transactions, and in order for us to actually read and understand those, we need to see them in the financial statements, which is a summary of those transactions. So what the financial statements allows us to do is understand how the company is earning its revenue, how it's incurring expenses, how it's raising and allocating capital, and what it owns and what it owes. And as I mentioned, financial statements are a summary of the transactions that have taken place, right? And through this summary, we have to learn about what the company is doing, right? We need to learn how the company is making profits, how its revenue is generated, expenses, etc. And this is why accounting can be tricky sometimes, because companies can distort their financial information because it's a summary. It's not a list of every single transaction they've made. And the question that we're going to ask ourselves as analysts is that, do financial statements always depict an appropriate and transparent picture of the company? And obviously the answer is that that's not the case, right? Otherwise we wouldn't need to do this lecture in the first place. But financial statements can be manipulated, and we'll see some examples of that. And what we often see is that many corporates tend to exploit accounting loopholes to misrepresent or manipulate their financial statements. So the key thing about an accounting loophole is that they're doing something that's legal, right? If you're exploiting a loophole, then what you're doing is legal, but it still may be the case that your accounts get misrepresented as a result, right? And because accounts are so complex, not every single eventuality can be covered by the rules, so there's sometimes room for discretion, and accounting loopholes can be exploited. Accounting red flags. Introduction. So when we see an accounting red flag, alright, which we'll talk about examples later on, accounting red flags are signs of potential trouble that should draw the caution of investors. So if we see evidence that a company may be misrepresenting its financial statements, so this could be in the form of exploiting loopholes, whereby they maybe show revenue very aggressively or something like that, then we should be on the lookout for these kinds of signs, and it's a potentially bad sign whenever we see this within a company. So some examples, we could have misrepresentation, we could have omission of information, so they don't include certain transactions or don't include much detail on them. We can have aggressive accounting techniques. As you'll see, when it comes to accounting, there are lots of different ways to account for things, and some are more aggressive and some are more conservative. And these may be all within the purview of the accounting standards, meaning that these are all legal maneuvers, right? So we're talking about companies that can do things legally but still misrepresent their accounts. And sometimes we have actual financial fraud that takes place. So in most cases, or in many cases, when we're thinking about accounting red flags, we'll be looking for things that are done legally but still misrepresent the company or misrepresent the company's financial position. And sometimes there will be cases where the company is simply lying on its accounts, right? There's actually fraud taking place, and perhaps they made transactions up or something like that. Unfortunately, these are difficult to detect well in advance, because typically, when we're analyzing a company, we use its financial statements to analyze the company, and we sort of end up having to accept that this is the information that's provided, and there's no real clue to say that this information might be completely wrong, right? Maybe all the numbers are wrong. So unfortunately, there's not really a way to. It's difficult to detect this in advance. But what we can aim to do is that we can certainly work to identify potential red flags, and then ultimately this can help us because we can not invest in companies that perform dubious transactions, and it allows us to protect our investment, right? So that's what we can hope to do by identifying potential accounting red flags. Why do companies distort financials? Now let's think about the motivation for a company to distort their financial statements, right? And as we said, sometimes we can have misrepresentation, sometimes we can have fraud, but often these might stem from a similar motivation, right? So what would make a company want to distort its financials? So the most basic factor is excessive greed and fear, and a company can misrepresent its statements. It can show, for example, higher revenues and profits than what it should be showing, and this can be the result of excessive greed and fear, and this is particularly the case for the management that is a big part of signing off and looking after the accounts. So one such example would be senior managers often have bonuses and incentives linked to sales and profits, right? Typically, companies like to pay managers money for their sales, right, based on the percentage of the amount of sales they make or the amount of profits they make, in order to incentivize them to work harder and to make more sales. So that's all fine, but it also creates an incentive for them to sometimes overstate their revenues and overstate their profits, right? Because it would mean that they get more of a greater personal reward from doing that. Another thing that companies can gain from distorting their financials is that they may get better terms from lenders and premium valuations from investors. So for example, if a company overstates its financial statements, let's say it shows very, very good revenues and maybe shows a very healthy balance sheet, then banks, for example, who lend to them would be able to give them lower interest rates, right? They would appear like a lower risk company to lend to, and this would help them. And likewise, they would get higher valuations from investors, so the stock would be worth more money, and this is useful for a lot of the people who own the stock, let's say management. And in addition, it's also useful in the sense that they can raise capital. If they want to do a secondary offering, they can raise capital at premium rates. And occasionally, in certain extreme cases, we find that promoters may resort to fraudulent practices to siphon off money from the company to their personal accounts. So this is now in the realm of outright accounting fraud, and you might see that if a company is doing very well, then they can take money for themselves from the company. And now what we're going to do is we're going to discuss some of the key accounting red flags that can help investors identify potential trouble. So one caveat here is that accounting red flags are not always easy to see. Companies that are preparing the accounts, if they want to misrepresent their accounts, will tend to go to great lengths to try and make it undetectable, right? So that's one thing to keep in mind. But obviously, as investors, we still must keep on the lookout for these things, which will allow us to identify potential trouble. Dubious related party transactions. So now we'll talk about related party transactions and ones that appear misleading or are dubious. Every company in its annual report is required by securities law to report all related party transactions. So what is a related party transaction? These are transactions that have happened between the company and its insiders. So typically you would think of transactions between the company's management or the board or something like that and the company itself. And it's important to have these transactions recorded or reported simply because there's great potential for conflict of interest with these type of transactions, so it's good for these to be in public view. So the insiders include the promoters and their families, top executives of the firm, as well as directors on the board. So this is a fairly large number of people, and these are all people who could have significant impact on the company based on their own transactions with them. So let's think about what kind of transactions we may be talking about. So these are some of the ones that related party transactions would include, but it's not restricted to this list, so there may be others as well. So one example is providing loans to insiders at favorable interest rates. So the company could loan money to an insider at a very low interest rate. Another such example, providing grants or donations with the cash from the firm to other firms controlled by the promoters. So this would be, for example, if let's say one of the management had another company that he owned all of it, then he could siphon off money from this company to his other one and reap a profit himself. And finally, using the company's cash to buy stakes in entities promoted by the friends or families of the insiders. So this is a similar concept. The companies might use its own money to actually invest in businesses that are controlled or owned by the insiders. So these are all examples of dubious related party transactions. So if we see an unusually large number of such transactions, this could be a red flag to investors, right? So typically these transactions tend to indicate a cash outflow from the company, right? Either giving a loan or a grant or donation or an investment. It represents a cash outflow for the company, and if there are a lot of these going on, it could indicate that not all is well within the company. So that's something to really keep in mind whenever we're looking at these related party transactions, right? We don't want to be in a situation where we feel that the insiders are just taking money out of the company because they expect that the company is going to do very, very badly in the future. The Satyam scam. Now we're going to talk about an example of a dubious related party transaction, and the example we'll talk about is the Satyam scam. And the Satyam's computer services scam provides a very valuable lesson to investors regarding the implications of related party transactions. The Satyam scam, if you can remember, was India's biggest corporate scandal. So this is quite significant, and this is probably one of the most important examples to talk about when we're thinking about accounting red flags, simply because it was so big. So how did this come about? Well, in January 2009, the chairman of Satyam,